It's the evening of January 23rd, 2026. The trading floors have emptied out, the chatter has died down, but if you're watching gold right now, you can sense it, that electric tension before a major move. I'm Robert, and I'm a private metals analyst. I've been accumulating physical gold and navigating these markets for over a decade. I built this channel because I was sick of waiting hours for the mainstream outlets to report what I was already seeing live on my terminal. And honestly, I was tired of all these AI avatar channels churning out recycled nonsense and fake hype about precious metals. So I use this avatar for one simple reason: speed. I can deliver you the real data faster than anyone else. No fluff, no theatrics, just pure analysis. Tonight, I need to walk you through something that's unfolding right now. Something the financial press won't dare touch because it reveals a system they don't want you to comprehend. Here's the setup. Gold just crossed $4,685 this week, the kind of milestone that should be headline news everywhere, that should have every financial analyst scrambling to explain what it means. But instead, we're getting the usual deflections. They're calling it a temporary spike, an overreaction to geopolitical noise, a speculative bubble that's bound to pop any day now. They want you to believe this is just momentum traders chasing returns, that gold's rally is tired, that maybe it's time to rotate back into equities or real estate or whatever narrative they're pushing this month. But here's what they're hiding from you. The screen is telling you a lie. Because while gold keeps printing new all-time highs, week after week, the mainstream explanation keeps changing. First, it was inflation fears. Then it was the banking crisis. Now it's geopolitical uncertainty. They can't settle on a story because they don't understand the real mechanism driving this move. And here's why this matters. Right now, as you're watching this, we are witnessing something that hasn't happened in over 40 years. Central banks are net buyers on a scale we've never seen before. Industrial demand is accelerating. Supply is constrained. And the paper market, the futures and derivatives that are supposed to reflect reality, is completely disconnected from the physical market. Let me tell you what I believe is actually happening here. Gold is breaking out because the global monetary system is cracking. That's the thesis. That's what I'm going to prove to you using hard data, documented central bank purchases, and supply-demand fundamentals that most retail investors never see. Here's the disconnect. Gold is trading at record highs, but the vast majority of investors still treat it like a relic, like a barbarous relic, to quote Keynes, like something your grandfather bought in the 1970s and kept in a safe deposit box. This isn't just ignorance. This isn't the market being slow to catch on. This is a structural blind spot that creates massive opportunity for those of us paying attention. And here's my promise to you. I'm going to break down the central bank buying wave. I'm going to show you the mathematics of supply deficits, and I'm going to reveal my personal positioning for what I expect over the next 90 days. Because here's the reality. In the past 18 months, central banks have purchased more gold than at any time since 1950. That's not speculation. That's reported data from the World Gold Council. The great repricing isn't a theory. It's happening right now. And I believe we're only in the second inning. So let's get into it. A few days ago, I was scanning my feeds. It was mid-afternoon. Gold was sitting just above $4,650, up a modest 0.3% for the day. Nothing dramatic on the surface, just another day of steady gains. But if you weren't watching the underlying flows, you missed the real story. Between 2 and 3 p.m. Eastern, we saw a coordinated spike. Gold jumped $40 in under an hour. The kind of move that doesn't happen from retail buying. The kind of move that screams institutional accumulation. This wasn't random. This was size. This was someone stepping in with serious capital and serious urgency. Now, the mainstream explanation would be that this was just algorithmic trading, high-frequency systems, reacting to some macro data point. But I've been watching these markets long enough to know what institutional buying looks like. It's deliberate, it's persistent, and it doesn't show up in the headlines. And here's where it gets fascinating. While that spike was happening, I pulled up the vault data from major depositories, and what I saw confirmed everything I've been saying for months. Physical demand is absolutely relentless. Refineries are running at capacity. Mints are reporting delays. Premiums on physical coins and bars are widening. That's not a market that's about to collapse. That's a market that's tightening. And when I looked at the futures positioning, I saw something even more revealing. The commercial traders, the big banks and institutions that typically short gold to provide liquidity, they're reducing their short positions. They're getting out of the way. That is not a bearish signal. That's a capitulation signal. That's the smart money acknowledging they've lost control of the narrative. And it made me ask the critical question. If gold is already at all-time highs, why is physical demand accelerating instead of slowing down? The answer is a fundamental shift in how the world views money. And to understand it, you need to understand the mechanics of central bank buying. Let me explain this concept because it's the foundation of everything. For decades, central banks operated under a simple framework. They held gold as a legacy asset, something inherited from the Bretton Woods era, but not particularly important in a world of floating currencies and dollar hegemony. The US dollar was the reserve currency. That was the system. That was the deal. But something changed after 2008, after the financial crisis, after the European debt crisis, after years of quantitative easing and negative interest rates and balance sheet expansion. Central banks, particularly those outside the Western sphere, started asking a dangerous question. What happens if the dollar's dominance ends? And they started acting on that question. China has been a net buyer of gold every single year since 2016. Russia accumulated aggressively until the sanctions hit. India has been adding to reserves. Turkey, Poland, Singapore, even traditional Western allies are diversifying away from pure dollar holdings. This isn't conspiracy theory. This is official reserve data published by these governments themselves. In 2023, central banks bought over 1,000 tons of gold. In 2024, they bought over 1,000 tons again. And in the first half of 2025, they were on pace to exceed that. Here's the math that matters. The total annual gold mine production is roughly 3,000 tons. If central banks are absorbing 1/3 of that production, and industrial demand takes another chunk, and jewelry demand in Asia takes another chunk, what's left for investment demand? What's left for ETFs and retail buyers and speculators? The answer is not much. And when supply is constrained and demand is rising, there's only one variable that can adjust: price. That's what we're seeing. That's what's driving gold higher. It's not speculation. It's not a bubble. It's mathematics. Now, before you think I'm just pumping my bags here, let me address the counter arguments, because there are legitimate reasons to be skeptical, and I want to engage with them honestly. Skeptic argument number 1: gold doesn't generate cash flow. The classic objection from equity investors. Why would you own an asset that just sits there and doesn't produce dividends or earnings? Here's my response. Gold is not an investment. It's insurance. It's a store of value. When currencies are being debased, when real interest rates are negative, when trust in the financial system is eroding, gold preserves purchasing power. That's the function. You don't measure gold's performance against the S&P 500. You measure it against the destruction of fiat currency. And on that metric, gold is outperforming spectacularly. The dollar has lost 98% of its purchasing power since 1913. Gold hasn't. That's the point. Skeptic argument number 2. The Fed could hike rates and crush gold. This is the fear that keeps gold bears confident. The idea that if inflation resurges, the Fed will slam on the brakes, jack up interest rates, and gold will collapse because higher rates make non-yielding assets less attractive. Here's the problem with that argument. The Fed is trapped. U.S. government debt is over $36 trillion. Every 1% increase in interest rates adds hundreds of billions to annual debt servicing costs. The math doesn't work. The Fed cannot sustain high rates without triggering a sovereign debt crisis. So they'll do what central banks always do when backed into a corner. They'll print, they'll ease. They'll find creative ways to inject liquidity while calling it something else. And every time they do that, it validates the thesis for holding gold. Skeptic argument number 3, digital currencies will replace gold. This is the tech optimist stream: Bitcoin, blockchain, central bank digital currencies. The idea that we're moving toward a purely digital financial system where gold becomes obsolete. I'm not anti-crypto. I think there's a place for digital assets. But here's what the crypto advocates miss. Gold has 5,000 years of history as money. It's recognized across every culture, every border, every political system. You can't hack it. You can't inflate it. You can't shut it down with a regulatory decree. And here's the key insight. Central banks aren't buying Bitcoin. They're buying gold. The institutions with the most information, the most resources, the most sophisticated risk management, they're choosing physical gold. That tells you everything you need to know about which asset they trust when the system is under stress. So what happens next? I'm watching 3 critical developments over the next 90 days. Number 1, the dollar index. If we see sustained weakness in the DXY, that's rocket fuel for gold. A weaker dollar makes gold cheaper for foreign buyers and amplifies the move higher. Number 2, real interest rates. If inflation expectations rise faster than nominal rates, real rates go negative, and negative real rates are gold's best friend. They make the opportunity cost of holding gold essentially zero. Number 3, geopolitical flashpoints. I'm not going to speculate on specific conflicts or crises, but we live in an increasingly multipolar world. Trade tensions, regional conflicts, sanctions, these create demand for neutral assets that sit outside the political system. Gold is that asset, and here's what I'm watching for as a signal that this move is accelerating. If we see gold break through $4,800 and hold it for more than 3 days, that's a technical breakout. That's the point where momentum traders pile in, where ETF inflows accelerate, where the financial media finally has to cover the story. There's no resistance level above $4,800. We're in price discovery mode. And in price discovery, moves can be violent and fast. Now let me tell you my personal strategy. And I want to be crystal clear. This is not financial advice. I'm just sharing how I'm navigating this based on over a decade of experience in these markets. I'm already positioned in physical gold. That's my core holding. That's the insurance policy I'm never selling. But I'm also watching for tactical opportunities to add exposure. Here's my specific trigger. If gold pulls back to $4,500 on profit taking or technical correction, I'm adding to my position. That would represent a healthy 4% pullback from current levels. Still well above major support, still within an established uptrend. That's a very specific, very disciplined entry point. It requires patience. It requires waiting for the market to come to me instead of chasing prices higher out of FOMO. Number 2 on my battle plan, I'm monitoring the gold to silver ratio. Right now it's sitting around 51-1. Historically, when this ratio gets compressed, meaning silver outperforms gold, it signals broad-based strength in precious metals. If we see that ratio drop toward 45-1, that tells me the entire sector is heating up. But here's my risk management. I'm not using leverage. I'm not trading futures. I'm not trying to be clever with options or derivatives. This is a simple, straightforward accumulation strategy. Buy physical, store it securely, be patient. Because here's what I've learned. The traders who blow up in this space are the ones who use too much leverage, who try to time every wiggle, who get shaken out by volatility. The people who build wealth in gold are the ones who understand it's a long-term position, not a trading vehicle. My target? I don't have a specific price target because I don't think in those terms. I think in terms of the macro environment. As long as central banks are printing, as long as debt levels are unsustainable, as long as geopolitical tensions are rising, the case for gold remains intact. When those conditions change, when we see genuine fiscal discipline, when we see real structural reforms, then maybe it's time to reassess. But we're nowhere close to that. Not even in the same zip code. Let me give you some broader context here because gold doesn't exist in isolation. Right now, we're seeing something unprecedented in financial markets. Stocks are near all-time highs, bonds are getting crushed, real estate is still elevated in most major markets. And gold is breaking records. What does that tell you? It tells you that traditional portfolio theory is breaking down. The old 60-40 stock-bond allocation doesn't work in this environment. Correlations are shifting. Risk is being repriced across asset classes. And in that environment, gold serves a unique function. It's not correlated to equities. It's not correlated to bonds. It moves based on its own supply-demand dynamics and its own monetary characteristics. That makes it the ultimate portfolio diversifier. I was reviewing some analysis last week that modeled a portfolio with a 5 to 10% gold allocation versus a traditional portfolio. And what the data showed was remarkable. The gold allocation reduced overall volatility while actually improving returns over a 20-year period. That's the holy grail of investing. Better returns with lower risk. And yet, most financial advisors still don't recommend gold. Most institutional portfolios are underweight or have zero exposure. That's the opportunity. That's the inefficiency. Now, I know some of you are thinking, if this is such a clear opportunity, why isn't everyone doing it? Great question. Let me answer it directly. First, recency bias. Most investors under 50 have no memory of gold's last major bull market in the 1970s. They grew up in an era of dollar strength and falling inflation. Gold was boring. It was something their grandparents owned, so they have no framework for understanding why it matters now. Second, the financial industry doesn't want to promote gold. There's no management fee. There's no commission structure. There's no annual revenue stream from someone holding physical gold in a vault. Banks and brokerage firms make money when you trade stocks and bonds, not when you buy gold and sit on it. Third, the narrative is sticky. For 40 years, the dominant narrative has been that stocks always go up, that diversification means owning different sectors within the stock market, that inflation is under control, and the Fed has everything managed. That narrative is deeply embedded. It takes a major shock to dislodge it. And that's why I'm so focused on the central bank data. Because central banks don't care about narratives. They don't care about financial media or analyst recommendations. They care about protecting their reserves. And they're buying gold at a pace we haven't seen in generations. Let me give you one more piece of historical context. In the 1970s, gold went from $35 to $850. That's a 24 times return. And it happened during a period that looks remarkably similar to today. Rising debt, currency instability, geopolitical tensions, loss of confidence in institutions. I'm not predicting that gold goes up 24 times from here. That would put it over $100,000 an ounce, which seems absurd. But even a move to $6,000 or $8,000 wouldn't be unprecedented in historical terms. It would simply represent gold repricing to reflect the massive expansion in monetary supply since 2008. The money supply has tripled. The debt has doubled. But gold has only doubled. The math doesn't add up. Eventually, something has to give. So here's my 3-sentence summary. Gold is at all-time highs because the global monetary system is fracturing. Central banks are buying at record pace while supply remains constrained. The mathematics of supply and demand make this the most compelling macro trade in the market. The numbers don't lie. The flows are real. And the trend is your friend until it isn't. Right now, that trend is firmly intact. All right, let me bring this to a close. I've been tracking these markets for over a decade. I've seen bull markets and bear markets. I've seen manipulation and capitulation. And I've learned that the most important skill in trading isn't being right. It's being patient. The opportunity in gold isn't about timing the perfect entry or exit. It's about understanding the macro forces at work and positioning accordingly. It's about recognizing when the fundamentals are overwhelmingly in your favor and having the discipline to act on that conviction. Right now, the fundamentals are screaming: central bank buying, supply constraints, currency debasement, geopolitical instability. These aren't short-term factors. These are structural forces that will take years to resolve. And that's why I'm not worried about daily volatility. I'm not panicking when gold pulls back 2% or 3%. I'm not checking the price every hour. I'm comfortable holding because I understand the thesis. And until that thesis changes, until we see genuine monetary reform and fiscal discipline, I'm staying positioned. Things are moving fast. If you want to understand the technical setup, if you want to see the chart patterns and support levels, go watch my deep dive on gold's technical breakout. I break down every key level you need to watch. I'll be monitoring developments closely. If we get a major breakout or a significant pullback, I'll be back with an update. Until then, stay disciplined, stay informed, and don't let the noise distract you from the signal. The opportunity is staring you in the face. The data is clear. The setup is there. Now you just have to decide if you're going to act on it. Stay sharp.